the deep dive. If you've been feeling like you're on an economic roller coaster lately, well, you are definitely not alone.
Mm-hmm.
There's just so much buzz about market uncertainty, and it's easy to wonder, are we, plummeting into some kind of spiraling nightmare?
Or is this actually a unique financial opportunity? If you know where to look, that is.
Exactly.
And that's really the core question we're here to unpack for you today.
Right.
In this deep dive, we're going to explore real-world indicators, real experiences, specifically by comparing our current economic climate to, well, the 2008 financial crisis.
The big one.
A huge one. Our mission here is really to help you understand the true financial situation we're facing and, crucially, to identify where potential opportunities might actually lie for your own finances.
Okay, so let's unpack this then. Our sources, they immediately hit us with this sense of just how rocky things feel right now.
Yeah, they really do.
When you look at the stock market, for example, what were some of the things that jumped out at you? The numbers, the descriptions?
Well, the figures are pretty stark, aren't they? The stock market, it had its worst start in over 80 years, back in the first quarter of 2022.
Wow, 80 years.
Yeah. Our sources describe it as just dip after dip after dip, like a sea of red for anyone investing.
I remember that feeling.
We saw drops. What was it? Down 21% from its peak at one point. And some sources even mentioned it being down like 43% from what they called the most serious recession in decades.
Oof. And it's not just, the numbers on a screen. These pressures really trickle down into everyday life, don't they? Like inflation. We hear about it constantly.
Well, they do. And it's a really crucial point. The government might officially report inflation at, say, 8.5%.
Right.
But there's a strong feeling, you definitely pick it up from our sources, that for many people, their actual day-to-day experience, it feels much higher.
Oh, absolutely. You feel it at the grocery store, at the pump.
Exactly. And then you layer on these global pressures like the Russia-Ukraine war, which has significantly hit global supply chains. And that's been driving up commodity prices. Oil is the obvious one, making things like just filling up your car so much more expensive. It really hits the wallet hard.
So are we seeing this broader impact reflected in the big economic numbers yet? Like GDP?
We are, definitely. That everyday pain is showing up. For instance, the GDP figures for Q1 2022 were pretty telling. Economists, they actually expected growth maybe 1.1%.
Yeah.
But what actually happened was a 1.4% decline.
Ouch. So by that measure.
By that measure, yeah, we were already technically halfway towards a recession.
It's no wonder then, is it that you hear this common sentiment out there?
Right.
This feeling that whether you put your money in stocks or Bitcoin or even just keep it sitting in a bank,
right,
you feel like you're losing ground.
Right.
Why do our sources suggest this has kind of led to people losing interest in investing generally?
Well, our sources suggest it's because people perceive this sort of lack of safe havens, right? When every traditional path, stock market, even basic savings, feels like a losing game because of inflation or market dips, the motivation to actively hunt for the best investment just kind of fades. It creates this almost like investment fatigue.
Yeah, that makes sense. What I find really fascinating here is how bringing in a business owner's perspective, someone feeling these effects, directly gives you this insight on supply chains, on customer demand, things that the official indicators might sort of gloss over.
It's such a valuable lens, isn't it? That ground level view.
Absolutely.
Yeah.
So let's use that lens. Let's compare the 2008 financial crisis with today through the eyes of a business owner.
Great idea. Let's start with, say, raw materials. Back in 2008, when the crisis hit, manufacturing really took a beating.
Right.
Industries like machinery, metals, transportation equipment, they saw customer orders just plummet, some down by like 42% in a single year.
Wow.
So because of that classic supply and demand thing, raw material costs actually went down back then. Sellers were, as one source put it, just eager to sell. They needed the cash.
So in 2008, too much supply, not enough demand, meant lower costs for materials. That is such a stark contrast to now, isn't it?
Oh, completely different world.
What's the situation today for businesses trying to get the materials they need?
Today, the raw materials market is described as being under considerable strain. It's costing businesses more than ever just to get hold of essential stuff.
Why is that?
It's this combination of really high market demand meeting reduced supply that keeps prices at levels, rates never previously seen globally.
Oh, wow.
Our sources gave a specific example, balsa wood. For model aircraft.
Yeah.
But it's also used in wind turbines now, so demand is sky high. Some customers are apparently facing a 3-month waiting list just to get it.
3 months for balsa wood. Incredible. Okay, what about supply chains then? Pre-2008, our sources say things were just humming along, right? Booming.
Absolutely humming. Pre-2008, factories were ramping up capacity, investing huge amounts in equipment, buildings, workers.
Right.
Supply chains were all about speed. They accepted costly transport, produced big batches because everyone assumed the goods would sell fast.
But then 2008 hit. A huge shock to the system, as our sources say.
Yeah.
How did that affect those super fast supply chains?
Well, it forced them to totally reevaluate everything. Demand just vanished. People were suddenly low on cash. And that meant shrinking orders for businesses, much more competition for the orders that were left, and profit margins just got squeezed massively.
Okay, and now, fast forward to 2022, our sources are saying supply chains are completely different. It sounds like the pandemic's slowdown effects are still lingering. They're not back to full speed.
Not even close, it seems. The situation now is that demand far outweighs supply, and that makes shipping just incredibly expensive.
How expensive are we talking?
Well, get this. One source mentioned a container shipment from China costing $17,000 in 2022.
$17,000.
Yeah. Compared to maybe $4,500 pre-pandemic.
That's almost 4 times as much. That's staggering.
It is. And here's another twist. Because oil prices are so high, ships are actually traveling slower deliberately. They can save up to 25% on fuel costs that way.
So things are more expensive and slower.
Exactly. It's this massive bottleneck.
Wow, I can only imagine what that $17,000 container does to a business's bottom line. So thinking about business operations, cutting costs, what were the main worries back in 2008 versus today?
That's another interesting contrast. In 2008, the business owner we heard from, their biggest worry was actually rent prices.
Rent, okay.
Yeah, which led them to make a pretty bold move.
Yeah.
They decided to buy all the buildings their businesses operated from.
Smart move, long term.
Very smart, to avoid those future rent hikes and protect their margins.
And now, in 2022, is that same focus on cost cutting there?
Oh, absolutely.
Yeah.
Maybe even more so, but the focus has shifted. Today, our sources say businesses are even more focused on cutting costs, but things like utilities are the big target now.
Because energy prices are up.
Exactly. So they're doing things like switching all their lighting to LEDs, putting in automatic lighting systems, anything to cut down that rising electricity bill.
Makes sense. Okay, finally, let's touch on consumer demand. We know 2008 to 2010, demand was way down. People were just low on cash.
Right.
But today, our sources kind of hint at a strange situation, almost a paradox. What's happening with consumer demand now?
It is quite interesting, isn't it? Today, it seems people actually seem to have more money overall, maybe from stimulus or savings during lockdowns.
Okay.
But the main problems now are these supply chain issues and worries about the recession.
So it's not just lack of cash.
Not entirely. The business owner shared this really telling comment. They have huge demand for products they can't get, but lower demand for products they have.
That's a bizarre imbalance. High demand for unavailable stuff,
Yeah.
low demand for stuff they have in stock.
Exactly. It's a really unusual situation. So, when you put it all together, yeah, the word recession makes us think of 2008. But the pressures today, they seem fundamentally different. It's not just about people not having money. It's this structural thing, too much demand chasing too few goods, constrained supply lines.
Raw materials costing a fortune.
Right. So history isn't just repeating itself neatly here. This feels like a new kind of challenge, and it probably needs a different playbook to navigate it, both for businesses and, for your personal finances.
Which definitely raises that big question for you, the listener. With all these really unique pressures, is there actually an opportunity here to profit? Or is this just something you have to sort of grit your teeth and weather?
And our sources offer, some good news and some bad news on that front.
Okay, let's start with the good news. What's the upside, potentially?
Well, the good news, historically speaking, is that the U.S. stock market does tend to recover after declines.
Mm-hmm.
And the data shows that investors that have stayed in the market for the long term have benefited the most.
Right. It's tempting to panic sell, but history suggests patience pays off. It reminds me a bit of February or March 2020, right at the start of the pandemic.
Exactly. Imagine selling right at the bottom then out of fear.
Only to watch the market roar back just a few months later.
Precisely. So the principle that buying low is where the real money is made still holds. And it's also important to remember, a recession doesn't always mean a decline in the stock market. Sometimes the market anticipates it.
So what strategies tend to work?
Well, tried and tested, things like index fund investing, just consistently buying the market over time.
Dollar cost averaging.
Right. And also picking the right defensive companies. That's a strategy mentioned.
Okay, let's clarify that. For our listeners, What makes a company defensive in this kind of economic climate?
Sure. So defensive companies are typically businesses whose products or services people keep buying even when times are tough.
Like necessities.
Exactly. Think utilities people still need electricity. Essential consumer goods, groceries, basic household items, or healthcare. Demand for these things tends to be more stable, less affected by the wider economy.
So they offer a bit more stability in a volatile market.
Generally, yes. That's the idea. They can offer a bit of a buffer.
Okay, that's the good news. What about the bad news? What are the risks or downsides we need to consider?
Well, the main bad news is the timeline. Historically, even though the market recovers, that recovery can take anywhere from 6 months to 2 years.
6 months to 2 years. That can feel like a very long time if you're watching your investments go sideways or down.
It really can. That time frame is psychologically tough for anyone investing consistently.
And I imagine it's especially tough if you're, say, on the verge of retirement, right? You might not have 2 years to wait for your portfolio to recover.
Absolutely. Someone nearing retirement can't necessarily weather 2 years of no returns or negative returns. It can seriously impact their plans. And there's also the harsh reality that not every company makes a swift recovery. Some struggle for longer.
And some never bounce back at all.
Sadly, yes. Some companies don't survive major downturns.
So tying this all together, it really highlights how important personal financial resilience is, doesn't it? Regardless of what the market's doing.
It really does. It's about preparing yourself personally, building that financial shield so you can handle any scenario, not just the one you expect.
That makes perfect sense. So practically speaking then, what concrete steps do our sources suggest you could take right now to build up that financial shield?
Well, a really critical first step mentioned is focusing on job security, doing what you can to maintain that constant, reliable income. That's your foundation.
Makes sense. What else?
Our sources also strongly advise extending your emergency fund. The standard advice is often 3 to 6 months of living expenses.
Right.
But in uncertain times like these, maybe aim for 6 months or maybe even more.
Why is that buffer so important?
It's crucial because it stops you from having to sell your investments at potentially the worst possible time when they're down, just because you hit an unexpected financial bump, like losing your job or a big medical bill.
Right, it gives you breathing room. Got it. What about actually tweaking investment strategies? Anything specific there?
Yeah, the sources suggest a potential tweak. Maybe leaning a bit more into those more recession-proof businesses and industries, the defensive ones we talked about.
Okay.
And, crucially, consistently investing,
Mhm.
especially into broad things like index funds. Don't try to time the market. Just keep steadily investing.
Consistency is key.
Always. One note of caution that came up was around cryptocurrencies.
Ah, yes. What's the thinking there?
Simply that we just don't have enough historical data on how they perform during a prolonged recession.
They're still pretty new in the grand scheme of things.
Exactly. They're a relatively new asset class, so predicting how they'll behave if we hit a serious extended downturn, it's much harder than with stocks or bonds. It's more of an unknown.
Okay, that's a fair point. So wrapping things up, we've really taken a deep dive today into the unique signals of our current economic moment, especially contrasting them with 2008.
Yeah, and what's really fascinating, I think, is the nuanced picture that emerges from our sources. It really challenges that idea that every downturn is just a repeat of the last one.
Right. It's not just 2008 again.
No. Instead, the sources highlight these specific, really fundamental differences in raw materials, in the supply chains, even in how consumers are behaving. That's what seems to define this potential recession.
So the takeaway is this potential recession really does feel like something completely different than 2008.
It does, but that doesn't make it less significant. It still presents a really critical moment for careful financial thinking and planning.
Absolutely. Which leaves you, our listener, with a final thought to ponder. How will understanding these unique pressures, this different landscape, shape your own strategies for navigating whatever comes next?